All right. Welcome back to another episode of Exploring the Process. We've got episode 8 here this week and a really special guest in Vexley. So it's at Vexley, VEXXLY. He's specialties basically in kind of options trading, gamma flow, et cetera, et cetera. So he actually has created a dashboard himself that I highly recommend you go take a look at. And he's going to be sharing some of those views today with us in terms of just some of his stuff that's important from a process-oriented standpoint. What he looks at to, in terms of support levels, resistance, et cetera, et cetera. So really excited to have him on. So welcome.
Cheers. Thanks for having me on.
Yeah. I mean, not to kind of take it to basics, but, love to hear just how you got started, what interested you in sort of the options environment, kind of tracking gamma flows and that kind of thing. And then, what transpired you to obviously one, create your dashboard, and then two, how do you kind of leverage it into your day-to-day process?
Yeah, sure. So background's fairly mixed. Started off as a pharmacist, like by training, hated pharmacy. So I moved into being a healthcare analyst where I was like building out like market research reports and stuff like that. So it was more of like a fundamental oriented role. Got introduced to like data and data analytics, slowly worked into like the data science kind of roles within like financial services and so on. Wanted to do my CFA level 1 and thankfully never actually went ahead and did that. So that was good on my part. So one of the things that like kind of like drew me to options was just the return profiles of them, right? So
Of course.
Was initially just like focusing on investing in stocks and so on, and then like I see like this whole other like world via options and realize like the money you can kind of make and also lose with them. But that like really piqued my interest, and I started spending like more and more time like using my data science skills to like focus on options in particular. Understood like the dynamics behind like market maker inventories, like after like going into the weeds and like reading academic papers and so on. And that kind of like built like the foundation of like what I've built out now effectively.
Awesome.
So do you still use any fundamental, like, or are you completely options driven now?
Yeah, I've basically like now just switched to just looking at options completely. I still have like the standard like SPY investments and like the FANGs and all that sort of jazz, and then like because of my background I'll invest in some biotech stocks which I just have a good feeling about drugs. But yeah, that's like super risky as well, as you've probably seen like a couple just like drop like 70% after an event or whatever.
Yeah,
that's like, because I know that's like sort of my area, my domain. I pay more attention on the fundamental side to healthcare stocks.
Sure. That makes sense. Can you overlay some of the options information there? I mean, I know, whether from a sector style or what have you, down into kind of the more granular, pharmaceutical companies, what have you.
Yeah. So it's actually like part of some of the results that I produce, like from the models that I've got. They go down to like sector specific classes. So I look at healthcare in particular, like via the XBI options market. So I pay attention to that. The thing with like some of the stocks that I look at, like generally they're like phase 2, phase 3. So
sure. So like small, like micro caps. Yeah.
So they're not super interesting on the options market. But then you'll get like some bigger companies like Biogen as an example. Like they had that Alzheimer's readout. That was like a great one to play on the option side because it was like such a huge like needle mover. So I'll look at options for the bigger companies.
Cool. So, I mean, from, I guess, in terms of like how you invest, right? Or like what I know you shared yesterday with us kind of some notes you send out to kind of some of your subscribers, et cetera. But, what exactly is the most impactful in terms of like how you have shifted, I guess, over time, from when you kind of first got into, the quote unquote options game, to where you are today, right? In terms of, what's adjusted, what's shifted, what have you still kind of like basically rely upon in terms of like key indicators or kind of like, levels, what have you, right? Would love to kind of know a bit more about that.
Yeah, so we've like it's essentially like what I've built into the dashboard, right? So I've like set it out and kind of like a user journey kind of thing. So you start off with like the gamma profile, which essentially mimics like the market maker inventories, and then we use that to identify like key gamma levels, is what we call it. So like areas of like, high interest in the options market, like based on what the gamma profiles are showing. That then like creates the view of like support and resistance at various points, and like you can see it, and so it's like it's kind of cool. Like you see it real time. Like it will hit down to like you'll see a stock like fall down to like 100, for example, and then it will all of a sudden like reject and bounce off. So that's quite cool to see. But that's like the first kind of point. Then we look at the delta profiles, and we want to see like are they sort of like in confluence. So if it's negative gamma, is there negative delta as well? And that gives you like more confidence. And like if you're trying to play the reversion, then okay, they're short on both aspects of the game, because you have to pay attention to both. So that's like another part. And then after that, it's sort of like go down the dashboard and kind of like look at, okay, well, is there interest in other options like further down the line, like by looking at volume and comparing that to OI? So if volume is like severely outstripping OI, open interest for those that are listening, and that's like visible on the dashboard as well. So I'd identify like levels there, because sometimes like given that gamma increases as you like get closer to the money, like there's going to be certain strikes that further up that you don't really see on the profiles as much, but you know that if the stock starts moving towards that direction, that's going to sort of exponentially increase, so it will become a point of interest.
Interesting. So then will you kind of like, will that attract your, like, obviously not just your eyesight, but will you start to kind of incorporate some of that? So if you're expecting it to continue to like rise, you'll, again, just for simple math, like it's like a 250 level or something, like you'll start to kind of buy, either short dated or longer dated kind of like options at that level.
Yeah, exactly. Yeah. Cool. And then the other part that's like super key is, and like you hear like traders kind of like mention this all the time, like stocks have personalities, right? But like for me, the way I kind of view it is like each stock is just a set of movements, either intraday or on a weekly basis. So we like to like identify like where is the move going to happen in terms of like a probability standpoint. So identifying like say you're going to take it intraday as an example, like you will look at the daily the daily return profile, and that will show you like close to close what's the like natural movement of the stock, and then using that profile you can identify, okay, like let's say it's on the tail end and the stock's been continually going down during the day, like a Roku or something like that. Let's say it's down like 15%, what's the probability of it going lower? And then if that probability is something like 0.4% or something, then you know, like from a historical basis, it's less likely to go lower unless there's some sort of contextual reason for that happening, like earnings. And then you can look to play the other side. And then that brings on the next point, which is, okay, now you've got that in your pocket. Where does the IV sit in terms of like calls and puts? So like if you just take a 10 plus delta, a minus 10 delta, and just compare the two. And that's what we typically do for the indices. So you take the spot price and just add 10, minus 10, just like make it simple. And you see, okay, well, what's the IV for puts? What's the IV for calls? And like, is it heavily skewed one way or the other? So like, if it's all going down, like you'd expect demand to be higher on the put side. And let's say the IV there is like three times or 4 times the call strike at the plus 10 delta, then you know that like it doesn't make sense for guys who are trying to really buy options like to the downside for them to take those. The risk reward trade is to go to the upside. So then it just like adds that extra like detail into our process. And then we've got like the final part, which is just a general seasonality. So like we look at, like over a weekly basis, not over a weekly basis rather, but over the year, like is this week typically a bullish week or a bearish week for that stock? And naturally, like you'll get some points where like there's not enough data, but it's always a valuable like data point to have.
Sure. I hadn't thought about doing it that way.
So do you find like, so if you think, so just taking it back to like the kind of the side that we look at in terms of Hedgeye and how they have quads and things, like if you back tested the seasonality part.
So that's like going into like the higher the value chain.
Okay.
So I started off with like, so I've got this roadmap that I'm building out, and I'm just focusing on like core features first, and then you get to a point where, because I think like if you look at like the Nomura's, the Goldman Sachs, stuff like that, you'll see these tweets that get posted out with like these ad hoc kind of bits of research, right? But like our aim is to make it dynamic so that you can see that like across the board for any stock. So like let's say you want to see how this plays out over like this week, like maybe using like a simulation, right? Then you can just do that for every stock. But then it gets hard because like that means more code, and then the complication and so on. So speak to the issue.
So when you were talking about the so as I'm building up, so bringing the options into my trading, I'm always like even more so. So I come from a trend following background, so I use time as an entry, but in terms of options and pricing, time is obviously there's the decay between that. So on everything that you've said about having an entry and using levels, you then have to factor in the fact that, okay, that level exists, but it's only going to exist, well, there's only 10 days till expiry on that. So is that automatically priced in? The fact that there's only 10 days, so let's say, until expiry, will that already be factored into the implied vol and everything else?
Yeah.
Or is there is there a trade to be made there as well? Like if it's mispriced in time?
Yeah. So like I guess like the time aspect is just dealing with like the probability of whether or not that volatility you're aiming for is going to land during that time frame, right?
Within the window,
yeah, exactly. So I mean, you benefit from like a lack of time. So like one of the things that we're like always looking for is like cheap gamma effectively, and you're only going to get cheap gamma in the shorter time frames. So you need to like make sure you're clinical with the level that you're trying to take, because like naturally, like just any bit of normal volatility can like really knock you out of your position straight away, right? So but for us, like we're tight with that in the first place. So it's like a 20% kind of risk management. Like if it's out, it's out. Like you just stop, sort of thing. If you want to go take it again, then that's like your prerogative. But
that's like a new trade.
Yeah, exactly. But you need to be clinical with the levels as a result. But then at the same time, like if you do land it, then your expected return over time, like let's say you hit like 3 or 4, you're going to land the 100%, the 200% or whatever, because you're like landing that particular point where the reversion is going to happen. And that leads back to like the research that's done on like market maker inventories. So like if you're dealing with a market that's very liquid on the option side, like market makers and I hope I'm like not misquoting here, but from the paper that I remember reading, market maker inventories can move on average around 723 million, and that's huge, right? Like especially if it's in like a smaller stock, like that's not necessarily going to be like the total amount, but if it's liquid enough and the general volume in it isn't much, then any volume that they provide in the form of a reversion is going to be enough to like get the couple of dollar move you need just to knock the deltas up fast enough, and then naturally the gamma fast enough to give you that move, and then you can get rid of most of your cost basis and maybe a bit of profit, and then just leave the rest.
Okay. So I first started on this when like looking at the squeeze metrics, the kind of free gamma level on the S&P 500. And it really piqued my interest, especially in 2021. So I made a few threads and stuff, and posted some stuff. I didn't realize until a few weeks ago that my DMs were locked, and the amount of DMs that I got for those threads, it was so strange. So I would just list all the points. So just using single days, if the gamma was negative, as it is on that website, the naive gamma, right? I just listed every single day that was negative and just said, right, the return's going to be, the expected return from all those were plus 6%, blah, 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 and it had 100% accuracy. So every single time it happened, it gave you a positive return in 2021. So I just started listing them as we come into 2022, just to highlight that these things that had 100% probability last year has now dropped to like I think as of last night, it was like 65% or something, just to highlight it. And when
that's a positive hit rate, or when you say 65%, 65% of the time, what is it doing? Sorry.
Well, yeah, because all of those ones that were giving you a big massive return in 2021, basically every buy the dip that happened in January to March the 2nd has now disappeared out of that window, right?
Got it.
And it's been replaced, and has now been replaced by all of the dips that weren't dips to be bought.
Sure. In 2022. Got it.
2022.
Okay.
So that's what's brought if the 1 year window is now shifted to the 3rd of March, it's brought the percentage positive down from 100 to like 65. And it was always like, so obviously now it's like you're fully in, everything's all in options now. Do you think, is that the way to go? I mean, I know it will be for you. I mean, is every trade an options trade?
No. So, I mean, I do use like commons sometimes, like if I want to like really size on a position, I can use both, right? Because then like I have more comfort with, okay, I don't have like time going against me at the same time. And then the other part is like just trading futures. Like I love like trading them because I don't have to worry about, I'm stuck in this like post-market window where I can't do anything. And then you get, especially in this market in particular, you just get stuck in this like gap where you're watching that the queues like fall down and you've got calls and you can't do anything about it. So like that's one area that I like particularly like focus on, and it's sort of like what I'm trying to like get people to understand is that you don't need to just play queues or like spy calls all the time, because there's all these other factors that you have to pay attention to. It's like futures for this stuff in particular is actually like good in my opinion anyway, just because I find like you can get in and out quite quickly, set your stops to like 5 on the E's or whatever, maybe 15 on NQ, and then like if you get stopped out, okay, you've only lost like a couple of points. Whereas like if it's the option, then like you've lost maybe 70, 80% just because of the way this market's kind of moved.
It was just because it was interesting that the DMs I was getting, it really shifted when things started to go against everyone.
Yeah.
Because it was like the whole narrative had changed, because because I was listing individual days, like on whatever, January the 27th, gamma was minus 1.4 billion or something, because I was listing them as individual days. There was one guy, he was saying, oh, you can't pick a point day. It can't be just a single point in time. And I was like, okay, but I'm just representing the data as it is, as I have it, as I can see it, just in a simple way to try and show. And then he said, right, and also you can't say that the average return is 6% because, any given time from that, it was much higher. It was like 12%. And I was like, hang on a minute. So you're telling me I can't use a single point as the gamma level, but in the 30-day window, I have to pick a single point at what the return was the highest. Yeah. And it was just like this guy, like, and I was trying to talk to him and I was getting annoyed, but I was trying to talk to him. I was like, is this like just is this free thing, this free page on a website? Is this just like what you've attached everything to? And the reason why I asked was like, I don't know how many, as we've gone through 2021 and into 2022, I don't know what it's been like for your subscribers, like how the people have been joining, but it just seems like it's like this, it is a help, but this stuff's been fed to people now. And for so many, especially the free stuff, is like, it's a what would you call it, like a lynch. It's like they have to like attach themselves to it, and it's like, oh, why isn't this working now?
Yeah, 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 yeah. No, definitely. So I found that people from the other platforms like come and flipped over uh, because of the fact that we like whilst we have the options models and so on, like when I'm not just saying, okay, you're just looking at this, that's it, like
Yeah.
nothing else. Because I don't like with any like market strat, I think it's a bit silly to just focus on the one thing. Like there's no algo out there that just uses one data point and then uses that as its entry, right? And if it does, it's not successful. Like
No.
like there's always a multitude of variables. Like it doesn't have to get super complicated, but there's always a couple like combined together to then generate that buy or that sell signal or that hold signal, right?
Yeah.
So yeah, I've found that like people like move over simply because like there's the other aspects like focusing on, okay, like where's IV, right? And you mentioned like before, like Hedgeye also like looks at that kind of stuff, like what's RV and IV, so realized vol versus implied vol, so those kinds of things. And then like just I think the other part that's like missing in a lot of cases is just like focusing on like, is that option cheap or not? Because a lot of people like don't factor that in. They're just like, okay, here's the gamma exposure, buy the dip, like Gex and Dix. Dix is high, Gex is low, so just must buy sort of thing. But it's just not the case, right? So you have to like think about all the other factors. And I think because it's like trading is such a like a instinctive kind of reaction, especially now, like it's so like available. It's just like at the click of a button on your phone, right?
Yeah.
People like automatically go into that system one kind of thinking of just like going straight in, but you have to think about all of the other factors, especially when you're like dealing with a derivative of the underlying, not
Okay. Yeah, exactly.
order.
Yeah, it's never. I mean, Keith, who's the CEO of Hedgeye, I mean, he's got a kind of he's got many sayings, but one in particular is it's never just one thing. It's never just. It's like it's a multitude of factors that you take in and you bring in from like in scope, right? And then you make a probability adjusted decision that ideally has a high outcome in your favor, right? Or like it has a high probability of return, right? Whether that's 20 basis points or to 20%, like it just depends on what you're trying to do. And so I mean it makes perfect sense. Like the eyeball like the eyeball structure again, it's like they put out a presentation every morning as part of the macro show, and it's a very critical page, and and certainly in my playbook, right, in terms of like going to that, looking at where is the eyeball and R vols for across the board, what's the Z score look like on a 12-month basis, et cetera, but that's just like one factor, right? Like it's then you factor it in. Again, I'm using kind of more equities versus the options side of things, Vex, but it's like volatility, what's volume doing, what's price, what's the price action going, and then you kind of start factoring in, okay, is it at an eyeball premium or discount? If it's at a premium, then it's likely that I'll maybe get a little bit bigger in size because because it's got basically that factor, that factor is in my favor, right? So rather than maybe going with the 2% position, I'll go with the 4 or something, right? So it's but I think sizing can be really important. It sounds like it's something that you factor into. I mean, whether it's from a checklist standpoint or at least that's what it sounded like. Is that accurate in terms of like a sizing scenario?
Yeah, we're not Wall Street bets here.
Yeah, exactly.
Unless it's like negative oil, which I wish I had jumped on that trade back when it actually came out. But no, like we keep like and like sort of what we advocate is like keep a strict size, like never like go beyond like a 5% max, like at the very most of like what you've got for this particular like options port that you're trading, right?
Sure.
And like I mean, if you're going to go like beyond that, there's got to be like a very 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 good reason for that to happen, like an extreme event, or you're just insider trading.
Yeah, exactly.
Yeah. So and then like I know there's like various like mechanisms like the Kelly sizing criteria and stuff like that as well. But I mean, like in reality, like the only people that really do that is the people that have that kind of analytics already built out, like via their platforms or whatever. So like more often than not, you kind of just have to just say, okay, this is my max size, and if I'm going to take a tactical position here because maybe like 2 or 3 out of 5 factors that I look at are okay, I'm only willing to take a 10% haircut in this case, and so on.
Yep. Yep.
So do you combine? So like if I don't know, oil, if you already have an oil position that's already on via futures,
yeah,
and you look to add via an option, do you consider that as a combined position?
Yeah,
like a combined risk, or
yeah, it would be the same thing. So like one of the things that I'm like kind of working on and like putting out in the dashboard is like looking at correlations, right? So like if I've got a certain position, I want to know like, okay, how is that going to correlate to like other assets, like typical assets that you might have included in your just general day-to-day trading, like just because you're looking at another stock or whatever. So yeah, those kinds of things are like things that we like kind of focus on, especially when you're just taking a trade just in general. Because like let's say the profile is looking a certain way, if its correlation to the Qs as an example, and the profile on that is maybe positive, but AMD is negative. Like if the Qs are moving in a certain direction, naturally because of correlation alone, AMD is going to move in the same direction as well, right? You're not going to get like those relative strength scenarios don't happen all the time. So probability is favoring the opposite. Like those kinds of things that we factor in.
Yeah,
that makes sense. And would you apply that even across like factor exposure? So if you have like 3 high beta stocks, right, and they're correlated to, you know, whatever SPHB or something, right, and you're like factoring all that in, so it's a combination of kind of like the underlying, even if they're in different sectors, right? So you know, you could have an energy high beta, you know, tech and healthcare or something, right? But they all have similar factor exposure. So so how does that, or like how do you guys consider that?
Yeah, so that's where like what we put out like currently is different to like how it's been viewed in the past. So we don't just look at exposure on a single stock basis, or just look at the indices and then say, okay, this is just going to be the direction based on the exposure of the indices. Like let's say SPY is down like maybe like 1 billion like negative gamma net over the forward looking 2 months, but then we split that out. We have like a view of like all of well the ETFs just in general, like the standard like XLE, XLF, XLK, and so on. But then like we've built out like some proprietary kind of sectors, and I hate saying that, but yeah, we're like we came up with like some sectors that we like thought, okay, these make sense, like high growth, high beta, like based on those factors, and then we look at gamma exposure and delta exposure on that basis to then figure out like, is there a move that's going to go in the other direction, even though it's maybe part of the underlying inside SPY or Qs.
Yeah, would you be willing to maybe talk to that or like bring that up and kind of show some of the listeners what that might look like?
Yeah, sure. Let me
That'd be awesome.
Right, can you see?
We can, yeah. It's one,
The screen, yeah. So what we do here is that we have like a list of sectors that build out, like some of them are just like simple, like straightforward, and you can gauge like some of this stuff just by looking at ETFs, right? So like if you're looking at ARK, you'd expect that to be like relatively similar to like a high growth, high beta sector anyway, because like generally all the stuff she's like invested in are innovators and they're going to move a lot and so on. Then you've got like other sectors,
at least in theory, right?
Yeah. And then you've got like banks as an example, and I guess you could look at XLK, I mean XLF, sorry, in that department too. But like we have like a certain like sector of banks that we know are like traded highly in the option market. Like BAC as an example is like one of those banks that's always on the top number of total contracts traded in the options market.
Interesting. I didn't know that.
Yeah. So that and you can see that stuff on like OCC, which publishes that information for free on their website all the time. So you get that view for anyone else who's like listening too. And then with like biotech as well, like instead of just like looking at XBI, like we'll take the large biotech companies like your Lilly's, Biogens and so on, and then group them up too. And then like where this stuff becomes useful is situations like where you sort of explain like the negative gamma exposure, and then there was like no positive return, or the positive return was like a lot lower on the 30-day look forward period, right? And then you've got these situations where, and even the people that provide like squeeze and so on were sort of saying, oh, does anyone actually, they put out a poll saying, does anyone believe in like high dicks, low gex at the moment, because the market just kept continuing, kind of like went down. And I think it's factors like this that if you like pay attention to, you can see why that's happening. So it's not showing it on this particular screenshot, but there was a point where you could see with SPY being extremely negative, you then also found big tech, which is over here, was positive. And if big tech is extremely positive in terms of its gamma environment, then naturally like the charm effects that are going to take place as that all begins to expire is going to have a sinking effect, right? And they're part of the underlying. And if like Apple and Microsoft as an example is like 10% of the Qs alone in terms of like total market cap, then if they're going down, then naturally the Qs are going to go down even more, despite the huge like negative gamma environment on the Qs as well. So those are the kinds
just explain charm quickly for us.
So charm is essentially just the rate at which theta is decaying. So like all of these like second order derivatives are just acceleration, as it were. So like if you think of theta as speed of decay, charm is the acceleration at which it's occurring. Yeah. So those are the things that like I find and like we find important, because like the market is just a group of stocks all moving in like various directions, and the indices are supposed to be the heartbeat. But if the underlying is moving in a certain direction and it's got enough weight, it's going to move it in the direction that you're not expecting based on like these kinds of factors.
Do you know what's really interesting there is I hadn't considered that. So Rob is like the king of finding not random ETFs, but especially levered ETFs and stuff like that. And I always, when I'm thinking about something, the first thing I do, like if it's a single name or anything, I don't really trade equities, but if people are talking about it or asking questions, the first thing I'll do is I'll figure out like what ETFs is it in, and then I can tell you what it's probably going to do. And I'd never considered it on that next level of, yes, pick stock A might be 20% of ETF Y, but it's actually the one that's maybe in the fourth biggest, which has the most options traded on it.
Yeah.
I hadn't thought about looking at it in that way.
Yeah. There's just certain ones that like have, or certain ETFs that just have more options traded on them, which is strange. And I think that applies to like semis in particular. Like SMH has more volume than, I think it was like SOX is the other one. And because I had like a sub like kind of mentioned, oh, why wouldn't you look at SOX? And I was like, there's like no volume on it. Like, it's not worth looking at from this dynamic. There's no point.
Exactly.
Yeah, it's just like understanding as well, like you need to have liquidity for the inventory to build in the first place, because if they're not selling risk, then there's no need for them to hold the inventory.
And that's the whole point. You're trying to leverage the fact that these guys have to hold the inventory or have to hedge against the options that they're selling.
Yeah, effectively, yeah. So like if they're, and just for the listeners, like if they're selling puts as an example, they need to sell, and if they're selling calls, then they need to buy as well, right? And those are the things that like drive the market the way that they've been driving it. Like we're moving like in what would be like a normal outlier day, like back in like 2015, just every day now. Like that's not normal. That's being driven by this dynamic.
So that's kind of to my question earlier when I said, is everything becoming an options trade?
Yeah, I mean,
like people like, I guess Mike Green comes to the top of my head. He like, the tail is wagging the dog now.
Yeah, exactly. Yeah. And I literally use that analogy. I think I use that on the analogy on the notebook review as well. It is that situation. Like when the options market is now reaching volumes that are like nearing futures, like just off like 2020, it was just shy of like the amount traded in futures. You're getting to a point where like the dynamic that's being set in the options market is basically dictating what's happening in the stock market, right? So like not paying attention to this, like even if you are like a longer term investor, like naturally if you're seeing like your your portfolio like move large percentages like within a day. Like you need to be just privy to like the dynamic itself, even if you're not looking to take those kinds of trades. You need to understand and like be aware of it, because like when it happens, like at least you're kind of like braced for it, even though like the psychological impact is always like harder to deal with.
And I think on the notebook review that you joined as well, I think I'd said that I kind of described it as a CV. It's like, even if you don't, like if you're a value investor or a long-term investor, and maybe you don't use options at all, like you need to have an understanding of it. I kind of described it then was, it's gone from a nice to have to a like a need to have. It's like a prerequisite now. It used to be, oh, it would be really good if you could use it Excel, and now it's like you have to know Excel inside out and code and this. So now it's, even if you're not purely an options trader, like you've said, you need to understand what's going on, if for nothing more to know that, like pulling your hair out on days where it's like, this doesn't make sense.
Yeah, 100%. And you get that all the time, especially like with the fundamental guys. Like you'll see tweets from like large accounts just sort of saying like, why is this happening? It doesn't make any sense. Like Tesla is the option like child, like as it were. Like if you look at any stock in the market and you want to understand where options are really like driving things, Tesla is that example, right? Like from a fundamental perspective, makes no sense, should not be where it's at, but it's being driven by these option volumes like all the time, and that's why it is where it's at effectively.
It's funny you say Tesla. The account that I use at the minute for futures isn't that great for options, at least for what I trade. But for Tesla, it's like there's nothing. It's like just a desert, and then there's every single strike and date and everything expiry you can imagine on Tesla, and then there's nothing else.
Yeah.
That's amazing. Is there anything else that kind of top of your mind, or that you think worth sharing, either from this screen or something else?
Yeah, sure. So like this is sort of like a view that I like send out like during the day, like in the morning, so that people like have like the overview with like the commentary, but then there's like the dashboard as well. So let me like flip over on the screen. So yeah, once you've got like the overview, like just based on like the gamma results, and like we track that daily, then like let's say you want to like go in and start looking at like the indices as an example, then we like start to drill in using the dashboard. So you get a view of like the gamma profiles, and I already post these levels because I like go and like take a look at it myself, and then like put the commentary based on that, like just like in terms of like what I'm seeing in terms of positioning. And like I think the good part about it, at least from like my perspective and like how I drive my process, is identifying like where short-term positioning is. And it's becoming more important now because funds are actively engaged in these like shorter dated option trades now. Like they're also taking part in this retail behavior where they're buying puts on short dated or calls on short dated side. So I would look at like this gamma profile as an example, and I'd identify like these key levels like straight away, say like 425, 430, 440, and so on, and then use those to like go back to like my trading view, and then say, okay, well, these are the levels that I'm seeing, compare that to volume profile, and start like comparing like where volume is being attracted. Because like ultimately all you care about is like, where is the volume like coming in? Like it's just an auction, and you just want to know where the imbalance is. So that's where this kind of comes in handy, because if I can use this and like understand that market makers are going to come in at particular points just from like a psychological level, like if I've got puts or you've got puts and there's a whole bunch of them and they're all reaching this kind of level here, and I know that like you're not going to just hold it the entire time, you're not going to diamond hand it, because it's like, why would you not take profit when you can? And then that's reflected like when you hit these points, right? Because you'll land like 425 and all of a sudden the market will just completely reverse and bounce up like one or two points just on SPY alone. And that's because of that dynamic of, okay, they'd sold those puts, i.e. the market makers, and then they held that inventory, but now they've bought back all of these puts that people have sold again because they've made their profit. Now they need to go buy back what they were short. And that's how you use it. Like, you just need to pay attention to those levels from that perspective. And then, yeah, like as I kind of mentioned before, like you can look through like volume for calls and puts, and then compare that to OI for the particular date, and just see like, okay, I've got 440 over here. Like, is that much higher than what I'm seeing over on the OI side? Like, is it much greater, sort of thing? And if it is, then that's just telling you like there's a particular point of interest, or maybe it's a case of just people just being completely burned. So like the people that were holding these positions in the past have now had to sell them all off because the price is like moved in the complete different direction. And then there's other people who are now taking advantage of that, taking on those cheap options and like gaming the convexity, as it were, because they're taking that, like they're taking the cheap gamma. So like if you visualize like gamma as a curve like that, like a bell curve, if you're taking the point like right on the tail, right when the option hasn't moved up, but you're gaming it and you're thinking it is going to move up higher, naturally gamma is going to move up faster, and that's going to affect delta, and then your option is going to move in the direction you want it to in terms of profit.
So just in terms of volume, you don't know whether the calls or puts, you don't know whether they're being bought or sold.
Yeah, on this visual you don't.
It's just a total amount.
Yeah. And then just like leading down the process, like you can then start seeing, okay, like Thursday as an example, right? Like you would just pay attention to like this particular chart and see, okay, well, these were the daily returns. Like I can see that like minus 3.05% as a bucket is 0.9% of returns, like less than equal to that. So like that's a major tail event. I can't see how it goes lower than that. Like I'm going to game it and take the upside, and then look at the vol surface. So you just want to see, okay, well, like where are the calls? Like this is how you like compare across the board. Okay, like where are puts in comparison, like 10 deltas down at like 53, and then same thing again with like calls if you want to see where 430 is in comparison. Like what's the difference? Those are the kinds of things. So it's built like a user journey as a in a way to like kind of just say, okay, like go down these points, build your mental checklist up, and then figure out, okay, like based on all of this, is this a trade I want to take?
Mm-hmm. So how do you incorporate kind of like the difference there in terms of like what you showed? I think you said puts were on the right, and then calls were on the left. So like how does that factor in?
Yeah, so like just going back to that Thursday example, and this is something that I like put in the commentary. I look at where the call is in comparison to the put on an equidistant delta. So so at that particular point, I think SPY was at like 420. I look at the E's and I just like correlate that back to SPY. And it was at 420-ish around that time. So I looked at 430 calls as a plus 10 delta, and then 410 puts as like the minus 10 delta. And I said, okay, like what's the difference in IV in comparison? And I could see, you can already see it here. Like there's a huge skew towards puts, right? But it was even greater at that particular point in time. And this just goes back to like kind of what I was like mentioning before. Like I feel like
it's
the market,
like you're like I've got a higher probability of taking the opposite side of this, given the other factors of it being like basically an outlier in terms of a tail event, et cetera. That makes perfect sense. Okay.
Yeah. And then you've got like the cost of the option, right? And if options, like just going along the line of options like driving the market, then like if you know that it doesn't favor more downside, and you've got this collection of like negative gamma, so the psychological like impact of like all these people aren't going to be taking in, like they're not going to just hold and like hope that it's going to go further down. They're already up like 200-300% or whatever it is. Like why are they not going to take profit? So then there's a reversion side there. And it just doesn't make sense for other people to buy more puts further down. So like you can't expect it to go down further without that offset effect. So then you've got like a strong like reason to take the trade. And then like as I kind of like mentioned before, you can look at seasonality as well. So this is just looking at average returns as it currently is. And then you can use that to kind of like game, okay, well, this is what like typically happens. And like we saw this in like Jan, right? Like we just continually like kind of went down, and it already shows you in the seasonality. So like, even if you wanted to just pay attention to that, then you could use that as like a starting point.
That's awesome.
Super cool. Yeah.
There's been a lot of
That's,
head banging.
I bet. I bet. Well, it's come together nicely. Awesome. And I know this, you got the Vexley link is on your Twitter profile. But then, folks can just kind of Google Vexley or whatever, right? And they'll come across some of your content.
Yeah.
Awesome.
Like links in my bio on my Twitter handle.
Awesome. That's great. Well, thank you for that. That was quite the education.
Cheers.
So how do you see the setup today?
So yeah, just like kind of what I mentioned yesterday, I saw us like kind of like moving up higher because of the skew.
Yeah.
And like it was necessary for us to like do that simply because like puts like further down were just too high in terms of IV. But that's kind of like normalized a bit more on SPY. It's not as bad as it was. And then you kind of got that reflexive sell that was there anyway, because people were just like, they're just waiting to take those puts because of like the macro indicators, right? So if you look at like the high yield index, like in terms of credit spreads, that's widening. If you're looking at like the 2-year and the 10-year as well, like that's flattening as well. So like for all these other signals are like still leaning downward. So people are still kind of waiting for that push down. They're just waiting for the opportune moment to then reload those puts again. And then we got that sell. The thing that's interesting is the Qs in comparison to SPY, like the trade for like calls and puts isn't as skewed. So like buying calls versus buying puts is nowhere near as skewed to the put side. So like, and I think what you're seeing it like throughout this kind of like period, like right from Jan, the Qs, like even though they're like more volatile, so that's like another indicator. But what I find is like the Qs start selling off faster than SPY. And I think it was like about a week and a half ago, SPY was kind of holding up, but Qs automatically started like dropping.
Yeah, they're down like 3%.
And then like maybe like I think it was like half an hour later, you then started seeing SPY draw down. And I was looking at this thinking like, what the hell's going on? Like this doesn't make sense. But yeah, like that's part of that dynamic, because the puts themselves are just cheaper than what is available currently on the SPY option chain. So then people are like gearing toward that.
It's weird that you say that, because I'm not to go back, but when you were talking about baskets, you can kind of build this basket of like things that done amazingly well in 2021. Like obviously for a time you had crypto, you had ARK, and I would start to add other bits like the
retailers,
carbon ETF.
Oh, carbon ETF, sure, KRBN.
And as you said, the SPY was holding up while the Qs was just getting pummeled day after day. And it's strange that all of these dominoes, if you like, have all been knocked off now. Obviously, crypto's been, knocked for 6 months or so. Qs has been taken out, or especially ARK has been taken out since September. And then finally, like the whole carbon trade has all kind of come to a halt over the last week or so.
Yeah.
So do you think that so when you said people were kind of prepared, people were waiting and like being preempted, wanted to put puts back on, will that kind of give us a level now? Will those puts being there, does that give us a kind of barrier that we won't go down much further?
Yeah, like when you get like, we're still in, we haven't like completely like cleaned the pipes, as it were, and like you can kind of see that from the vol surface, right? Like it's still heavily skewed, especially when you're moving like further down, like the deltas, like when you move to like -20 delta, it's still super skewed. So like for that's why I was kind of like saying we need to go up a bit more for us to actually like come back down, because it just doesn't favor the trade at the moment.
So in a way, although we kind of got to that 4,400, I guess, coming into today, and people wanted to put their puts back on, we almost need this. We need this move to the upside to clear all that out before you're going to get another meaningful move lower.
Yeah, exactly. And like when you collect too much like negative gamma exposure in one particular area, like the trade's crowded, right? And it applies across the board, whether it's futures, stocks, whatever. If there's just too much queued to one side, naturally, like the reverse is gonna like take place at one point. And the same applies with options.
Yeah, it's interesting. I was just listening. I was listening to the Notebook review last night, Rob. Well, I was listening to it this morning, the recording, right?
Yeah.
And it just seemed like everyone was just kind of, there was a lot of emotions, there was a lot of feelings, and like everyone was just talking about the shorts that they want to put back on. They've like already picked them out. They know what they want to short. That everything is. Everyone's like, I'm just waiting for this. I just need to get these shorts back on.
Yeah, and again, I mean, 24 hours later, market was down. So I mean, your shorts definitely work today. But I'm with. I mean, what I'm seeing is like we've got a bit of a level here, Vex. I mean, I don't really. I use other stuff to kind of make that decision, but I'm definitely skewed. I think we have a big time downside risk. I think in the near, I'm talking much more near term, right? I think like between the next 2 weeks are going to be very, very interesting in my humble opinion, because of, just events that are in data points that are coming out, right? You've got, NFP, I think you have non-farm payrolls later this week on Thursday. You've obviously got the Fed meeting, you've got OPEX the next day, I believe it is. And then you've got obviously, kind of quarter end and stuff like that too, right? So you're going to have a very, just from a, I just think you're going to have a very interesting month of March, but in particular, this next 2 weeks, I think you're going to get a lot of head fakes and a lot of like bear market bounce. You're going to get big bounces and like little, like kind of sell-offs like today that are relatively organized, I would say, right? Again, I wasn't like I had just a ton of meetings today. So I wasn't as focused on the trading aspect today, but I'll be doing that review later to kind of assess what actually went down. But yeah, it's definitely the last night's review. I was very jokingly like commenting how it was very feelings oriented, right? I was like, kind of felt like a bit of a shrink, right?
Like
just like letting everybody letting everybody like vent, and like, everyone was in a safe space, right? It was like, you're in a and yeah. So, but it's just, there's a component. I think what your dashboard shows, Vex, there's a component of, especially for like many of our listeners, for Chris and I, like at the Hedge Eye, like we've got like the quad model, right? So like you have this sort of like roadmap as to like where we're headed, and it's an absolute game changer. And I found Hedge Eye in like April of 2020. It's been an absolute game changer in terms of like my philosophy, investment approach, just pretty much across the board. I mean, it's been fantastic. But there's these other underlying things, and these are aspects that, Chris is open my eyes to, yourself, like, in terms of like these underlying options trade, which I never, ever, ever would have, like, other than just playing, like basically buying a call or buying a put or whatever, I would never really have been factoring it into like some entry points and stuff like that. And I think those are really important, because there's such an intricacy, and it's such a dance between the short-term moves that occur and then the longer term kind of like full investing cycle is what kind of like Hedge Eye calls it, right? So it's like there's these moves that are sometimes even intraday, right? In terms of like, we saw that was it Monday, maybe, I forget which day it was. Basically, it was, we were down like 2% and then we closed the day up like 1%, right? And we had those all the time in 2020. Like I remember March or February of 2020, it was like almost every day it felt like we were up 2% and then we would close down 1%, right? Or we were down 4%, we'd close up 50 basis points. And it's just like, and I think we're going to have a lot of that in the near term. So there's going to be a lot of, if you're nimble, you can certainly make you should be able to, if you're nimble and have a good process in place, like, Chris and you both have, great checklists, right? And it's like, for Vex, you mentioned there's like 5 things, right? So if you've got, 3 of those, you're you're going to kind of take a smaller position. But if it's really lining up like it did last Thursday, I have a feeling that you probably put on pretty decent chunk of change in the spies, and hopefully it panned out for you. But I think, you've got your process, and it's slightly different than ours, but there's a ton of overlap, so it's very, like we look at the yield curve and all that kind of, like, it's just all that stuff factors in. And so it's really quite wonderful to speak with you, for you to open up your kind of kimono here and show us your VEX dashboard. So we really do appreciate it.
Yeah, no, cheers. Thanks for having me. It's been good
Awesome.
talk.
All right. Well, we'll see you guys next week, and hopefully another special guest. I'm not sure, it's going to be hard to top VEX, but we'll see what we can do. All right, y'all.
Take care. Cheers.